When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be discussing wealth preservation and risk management. We'll answer listener questions and then finally long-term care strategies for families with large estates. I'm Jeff Shea, just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. Of course, it would be Jeff Hogan of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. Always great to be with you and with the listeners. It's fun. Way to just get a lot of things off my chest.
Yeah, this is our time to vent. Pretty much every week I ask you a question, then you vent for 10 minutes or so. But it's always great to hear your opinion on things. So many retirement shows out there, and we're a lot more than just retirement, but you hear the same old boring stuff every week. So if you want to know what's going on currently in the market, you want an expert opinion, you are in the right place right now. I'll start by giving the phone number, Jeff, 520-780-9059. You hear anything in the program today that prompts your interest, you want to talk to Jeff about preserving your wealth or creating an income stream that you can't outlive, or you want to reduce taxes, again, that's the magic number, 520-780-9059. When we talk about wealth protection, Jeff, especially for high-earning professionals, what does that really mean? I mean, what are the biggest risks that people underestimate?
Well, I think they underestimate the fact that the market goes down way faster than it goes up. It takes years sometimes to earn a good return on your assets, and it takes days or weeks sometimes to give it all back. And we've seen 6 months of gains in a lot of stocks be given back just this last week. We have to keep in mind that it can be ruthless, and you never know when the market corrects. It could be years before it gets back to even where you were. So many times we get this idea that, oh man, I got to get out. Oh, this is terrible. This is really hurting my gut. I got to get out, but I'm going to wait till it bounces back and gets back to even before I get out. I hate to say it, but that might be years. You know, if you did that in 2008, you would have waited till 2014 or 15 to get out. You would have rode it all the way down and all the way back up. It would never have happened. So do you really want to do that? Or do you say, hey, I was up 40%. I just gave back 20. I'm still up 20. That's still a good year. Let's take the profits and be happy. And let's be careful with our money. And again, that's if you are in a place where you're not afford to lose anymore, or you want to start taking some of the profits to protect the principal for your retirement plan. And I don't know if that answered your question, but that's just one of the things that came to mind.
Jeff, as it relates to our conversation here about wealth protection and risk management for high net worth individuals, physicians and business owners are often told that they have a target on their back. Why are these groups so vulnerable from an asset protection standpoint?
Well, I think every scammer wants to get at their money. They know that these people you're mentioning make high income, and very often a person's smart enough to get through law school, med school, pass a CPA exam, etc., aren't necessarily the most informed when it comes to investment opportunities or how everything works. They're really good in their field. I wouldn't go to an accountant to do surgery. I'd go to a doctor, but I wouldn't go to a doctor to give me financial advice. Because quite frankly, most of them that I meet, the smart ones, come in ready to understand that somebody might be smarter than them about financial matters and things that they don't focus on every day. These guys live and breathe, just like I do, money. They live and breathe healthcare or legal or other things. And so I think they're easy. They don't want to appear ignorant or less smart than they really are. And so I think they can be taken advantage of by a good flim-flam man and a salesman who pitches a good thing. And they don't want to act dumb and say, oh, no, I don't think I want to do this, because they don't understand it. They want to pretend they understand it sometimes. I think maybe it's just ego sometimes. And I have that too. I don't want to feel stupid. I want to feel like I know what I'm doing. And I know that's gotten me in trouble several times in areas that I'm not really that familiar with. And I've been taken advantage of. Shoot, I bought a timeshare even. Yeah, even me. So all of us can be taken advantage and get caught up in the hype, and we think we're smart enough to understand. And then we find out, oh, we wish we wouldn't have done it. I'm not saying timeshares are bad for everybody. I just think that they're one of those things that don't count as a really good investment unless you use it a lot, unless you really love the vacation where you buy it. Many of my clients do, and I do actually enjoy it. So I shouldn't have probably gone there. But when it comes to retirement plan, you stick your money into this brand new real estate investment that's going to generate 20% per year and blah, 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 blah. And then it doesn't. And your money's tied up. You find out you only get 30% of your money back. And you're like, what happened? I thought this was safe. And the guy who sold it to me said it was safe. Maybe the guy who sold to you even thought it was safe. But the bottom line is sometimes we get caught up in some investments that are kind of alternative investments that are more based on hype and a good salesman than doing the due diligence and research. So I think some of these high net worth people really don't have time to do the due diligence. They need to find somebody they trust as they need to be in order to truly be a good fiduciary advisor for those people. I think people don't look hard enough maybe, or they just trust the first guy that sounds smart. I think sometimes we can be a little over trusting. So be careful. Do some tire kicking and do some due diligence. Make sure you feel comfortable with the things you invest in. Make sure you understand how they work. You don't need to understand everything, but at least get a good idea of the summary of the data or the bullet points that make it work so that you understand it, feel comfortable going forward. Otherwise, you can make mistakes.
Talking with Jeff Vogan on Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about high net worth individuals here, wealth protection and risk management. If you fall into that category, you're looking for more than just a standard financial advisor, but somebody who really does understand the challenges that you may go through. The fact that you may have a target on your back, call us here at Premier Retirement. Talk to Jeff Vogan about this. 520-780-9059 is our number. You can make that call right now if you want. Leave your name, telephone number. Shelley will call you back during the week, and she'll set up that appointment for you at no cost and no obligation whatsoever. It's just a casual conversation between you and Jeff to talk about your needs, your wants, your desires, and your goals. Again, it's not going to cost you a dime. 520-780-9059. You can also find out more about the firm online at premret.com. That's premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we'll continue this discussion, but we'll also answer listener questions and more when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thank you so much for making this a part of your weekend. You're listening to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. If you've heard the show today, you're not having these sort of conversations with your current financial advisor. Maybe it is time to get a second opinion. You can do that by calling 520-780-9059. Talk to Jeff Vogan here at Premier Retirement. It's not going to cost you a dime to do that. Wouldn't you like a second opinion about your retirement income? And certainly you want to talk about your individual needs. No cookie cutter approaches here at Premier Retirement. 520-780-9059 for that complimentary consultation. Also online at premret.com. Also want to remind you that we're on the air for you 4 times a week, Saturdays at 7 and 9 a.m., also 1 p.m., and then on Sundays at 11 a.m., and 24/7, 365. We're on the podcast there. Go to wherever you get your podcasts. Search for Premier Retirement with Jeff Vogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Okay, Jeff, always love hearing from our listeners. And let's start off our question and answer segment this week with Jim listening to us in Stone Canyon. Jim says, I'm 58 and have done well with my business. My net worth is about $3 million right now. My goal for my money is to provide a retirement in which my wife and I can travel the world in style. But we also want to leave our 2 children a nice inheritance. To me, stocks and bonds are boring and somewhat predictable. I've heard that the smart money is in private equity and private credit. What's your opinion on this?
Well, private equity you can get if you're an accredited investor, and obviously you are with that net worth, and you could go out and look for things that are already set up, basically a portfolio of assets. Sometimes they resemble REITs, real estate investment trusts. Sometimes they invest with a whole bunch of debt, basically. Most private equity is basically private lenders that are willing to give quick and easy loans to companies that don't have to go through the rigmarole of qualifying and doing all the paperwork and having the audits and the scrutiny that a bank would require. So they're willing to pay higher interest rates, typically for more short term. I know one private equity that our company invested in, one of their cool things they did was they basically loan diamond importers money on the diamonds. They collateralize the diamonds, but they just get them here quicker, would get through custom quicker. And there was always such a markup. They always made easy money. And so it was like, okay, well, that's a pretty safe investment and it's backed by collateral. Some private equity, I just used that as it came to mind, but it could be real estate loans. It could be factoring for maybe somebody gets a lawsuit and they're waiting for their settlement and they know they're going to get it. It's just paid over time and somebody wants money up front. Maybe the private equity buys that note, then they get paid the Philip Morris money or something like that that's going to come in over time. Or Corning, there's another big suit that everybody heard about, and some of the other things that are out there. But private equity is an asset class. Sometimes it actually resembles a mutual fund. And the organization that I belong to, between us independent offices that belong to it, have, I think, somewhere in 120 to $150 billion in assets. I don't know where it is right now under management across the country. And we have a lot of buying power. We can go out and say, hey, we need a private equity firm to create a ticker symbol for us, and we can actually put it on Fidelity and trade it and get in and out of it with sometimes limited liquidity. But you can participate in private equity that way. Typically, it's not something you can just buy off the shelf on a retail account, however, so you can't do it yourself. You probably need an advisor to get access. Or you need to find somebody at the golf club that's into private equity. He can introduce you to his board of the members, and you can do a private equity investment yourself. However, keep in mind that these things often are not liquid. I prefer the ones that have a ticker and are tradable on an exchange, held at Vanguard, Fidelity, or one of the big custodians. But private equity is something that you can look for. Now, I do a lot of private equity personally. I loan money on real estate sometimes. Somebody needs to get in quick and can't qualify or has too much property, they're property rich and asset poor. My son was in that business, so he turns me on to people sometimes. If I have a little cash laying around, I'll invest in that. It takes a little bit of work and due diligence, so that is like a job. So I don't know if you want a job in retirement. You might want to just let things ride. I know you said stocks a month seem boring. I don't know. There's not a lot boring. That's what I get up in the morning early for. Is the thing that isn't boring is all the insured products that are principal protected that give you guaranteed income that help you live life on your own terms that you don't have to watch and you don't have to get excited about. But if you're looking for something that gets you out of bed in the morning, honestly, I don't think private equity is going to be that either unless you're out looking for your own deals. So again, you can look for your own deals. I don't look for my own deals. I don't have time for it, but I have people bring me deals. So, maybe you can get in a place where that happens and you can find somebody that has deals or somebody that's in the market that maybe is doing fix and flip houses and needs money once in a while. Maybe you can do a private equity deal with that person or something like that. Or just people that need loans, and you can usually charge high interest because they need it for a short time. It's a convenience factor, and that might excite you or give you something to do in retirement that's more fun to do. Use your other half of the day after golf to do or something, whatever it is you do. Private equity, it comes in many forms. There was a big article just this last week. Wait till you see what happens to private equity. There's a lot of defaults and there's a lot of bankruptcies going on with businesses because the economy really isn't what it looks like it is or what it's hyped to be on the news. We're also looking at tariffs really are hurting some companies, and they're basically sifting out the men from the boys. There's a big day of reckoning coming on who's got too tight of profit margins and who can't borrow money, and the people that have bigger profit margins or the people that are big enough to borrow money easily from banks and collateralize their loans are continuing to overcome some of these extra pressures on the bottom line, and some of the smaller companies can't. It's typically the smaller companies that are dealing with private equity lenders. And so I think going forward, just based on the way the market is right now, I would be very cautious on any private lending, even in the real estate market, like I was mentioning that some of my clients do. But there's going to come a day when if the market does correct and the real estate market follows, there may be a big default risk. So be careful no matter what you do to get involved in that. I would say if you've got $3 million in your retirement and you're living off of it, I would not put any of that money that you can't afford to lose. I mean, I would still consider private equity, whether it's collateralized or not, whether it seems well run or not, I would still consider it risk money because there's always default risk. And default risk usually follows market risk and things like that that are staring us in the face right now. So be careful moving forward. I would be a lot more confident recommending you get into private equity with a small portion of your assets, maybe 10% of everything, after you've put 2/3 of it in principal protected assets that generate close to, let's say, $100,000 a year guaranteed. So you don't have to worry about missing your next meal or missing your next vacation or missing your next trip to see your kids or grandkids. At least get the income part solid and guaranteed, then go risk your money on things that are exciting to you, like stocks, bonds, stock picking, day trading, private equity, whatever it is. Make sure the basis, the foundation is set. The last 5 or 10 years, people who have retired in the last 5 or 10 years, and if you're in that boat, you really haven't experienced a market correction while you haven't had a paycheck coming from a job. If your paychecks are coming from your portfolio, market corrections have a whole new meaning, and you'll find out the hard way if you don't imagine it, understand it, and realize what it would mean to you if half your net worth was gone one day because it was all in the market, or because the private equity firm went out of business and wasn't able to collect the money that was owed them, which is the money they owe you. So again, caution, always protect what you have. You worked a long time. You've done well. You've been smart enough to save a few $1,000,000 for retirement. Don't risk it and don't lose it by making silly decisions.
Jim, we appreciate that question. And of course, if you want to talk to Jeff, you can get in touch with him a couple different ways, really. You can call 520-780-9059. And because you're in Stone Canyon, you might be able to hook up with Jeff on the golf course there, too. So look out for Jeff there. Again, no cost, no obligation. He would love to talk to you. Okay, Jeff, let's move on down to Vail right now and hear from Linda. I always like Vail. They got the two big railroad spikes there that form the big V there. Vail was a stop along the Pacific Railroad for water, but nevertheless, Linda is listening to us. Linda says, I'm a 63-year-old woman. I was forced into early retirement. I have no debt except for my house. I have $600,000 in my 401k, most of which is in a Roth 401k and the rest in a pre-tax account. I also have $55,000 in a Roth in a brokerage firm. Now that I've been laid off, my advisor has encouraged me to move all of my money to his brokerage firm. I asked him to run the financial scenarios for me and how much money I can safely take out of my account now that I'm retiring early, quote unquote. I feel good about what he's sharing with me, but I'm nervous about all my money being in the hands of one brokerage account. I still have horrible memories of the Bernie Madoff scandal with people losing all of their money with one person. When I voiced this concern with a brokerage guy, he says he understands, but then he says he can't guarantee the returns if I leave some of my money in another account. Is there any way that I can protect myself from this? How should I proceed?
Well, I'm kind of of the same persuasion. It's really hard to be a good fiduciary advisor if you got three other advisors talking in your ears and doing different things with your money. I don't know what role I have to play. If you're going to quarterback the team and I'm on the team, but I don't know what the other players are doing, that's difficult. And honestly, most other advisors don't want to work with each other. I understand that all eggs in one basket are all with one advisor. I think you need to find an advisor you trust. Bernie Madoff was actually Ponzi scheming the money. He was just taking the next influx of money and falsifying records and things. You know, if you have an account, and it wasn't an account at Fidelity or some big firm that you could just log in and look at. It was Bernie Madoff, and he was just printing out statements and things. It was kind of it wasn't really high tech. It was kind of old school. And everybody just trusted him and believed him because he was walking around and hobnobbing with big charities and things like that. And everybody trusts a charitable guy, I guess. Kind of like they trust every accountant, they trust every charitable guy. Some of them are great. Some of them really don't know what they're doing. No offense to accountants or charitable guys. But the bottom line, sometimes we don't really do the due diligence and we just jump in there. Same with financial guys. There's a lot of people that just really are uninformed, or they get the direction from maybe somebody on Wall Street that tells them what to do every day, and they really don't have a mind of their own, and they really can't appeal to your own interests or your own values or even supply the services that you need because they're not offered by the firm. So I think what you need to do is make sure the firm, if this person is just moving your money from a 401k and managing it in a similar asset allocation that he gets a fee for, but you like him being there and holding your hand and answering questions, then maybe he's the right guy. But keep in mind, if all he has is stocks, bonds to offer, you're still at risk. And if he says the word guarantee, that if you move it someplace else or split it up, I can't guarantee you these returns. Well, if they're securities, root word secure, not secure in reality, that's a kind of an illegal, uncompliant way to describe income. You cannot guarantee, even if you use the rule of thumb, like a 4% rule, there's no guarantee of income unless you're using principal protected assets. And those are typically offered by insurance companies. And that's why we straddle the fence a little bit. We have one foot in the market, and we have another foot in safety. And the safety things are those things that are insured, secured, and backed by some sort of not just assets at the company, but also a level of insurance beyond that. And that's where we like to put assets. And the reason I don't work for a big name firm, I have my own, it's Premier Retirement Planning and Wealth Management. Premier Wealth Advisors is my registered investment advisory. The reason I started my own is because I didn't want to take directions from a big company. I didn't want to be limited in scope by what they would let me offer. Most broker dealers only want to deal with Wall Street products, stocks, bonds, and cash, and say, don't worry, hold on, ride it out. As a fiduciary, you should be allowed to do what the client wants. And if it's to protect some assets by insuring an account, in principle protecting it, and offering income that's guaranteed regardless of how the underlying asset performs, which stocks, bonds, mutual funds, ETFs can't do, then you need to be able to work with somebody that does that. And I think if you saw a comprehensive plan like the ones we offer, and I guess I'm probably not the only one. I'm only one I know who does it as well as we do. Obviously, I'm a little biased, but we do comprehensive planning. We use all the buckets. You can use one advisor, but your money is not going to be in one bucket. I'm going to quarterback the team. We're going to play offense. We're also going to play defense. We're going to have both sides of the field covered, and you're the owner of the team, and you could even be coach. But, if you want me to quarterback it, I can't run every play and do everything. I can't pass it to myself. I've got to pass some of these assets on to another player who can take care of them, who watches them every day, who protects the principal, who gives us better than typical fixed money or safe money returns, and can guarantee you income so that your paychecks are taken care of from now till the time you pass away. So you never have to worry about where your next meal is going to come from, or whether you have enough money in the bank to take that trip you want to take, or to fix the air conditioner when it goes out, or to wine and dine your kids when they come to visit. You want to have that guaranteed income and not be subject to the next market crash and say, oh, sorry, kids, you can't come out, or I can't afford to fly. The market's down 50% and I have to wait till it comes back before I can afford to do anything. Because if I keep spending money, I'm going to be locking in losses. I can't afford to do that. Well, you might only find out about that after it's too late. After the market crashes, they say, oh, wow, this isn't, by golly, that broker really didn't guarantee my income. Doesn't look like we're going to make it here. If I keep spending money, I might run out if the market doesn't rebound quick. Then where are they? Hey, the market does what the market does. Don't worry, it always comes back. They always say the same cliche stuff, but does it really work? No, not unless you have principal protection and income guarantees on some of your money. The money that you need to live on needs to be guaranteed. It needs to be in a place probably different. And I'm sensing that your advisor was probably advising you in the market with your 401k that wants to just move it over with his firm, may do just the same stuff, just you pay him the fee instead of the 401k company. So be careful. Look for more comprehensive plans. I would see what he has to say and compare it to other plans around town. Come see people like us that are more independent, that can work for you, not for a company. And you might find a different flavor, something that makes you a little happy, and understand that just by dealing with one advisor where you have all your money managed at that firm, and by the way, you can unmanage it with that firm anytime if you don't like it. You may have different asset mixes, access to different asset classes, access to different strategies that are tax efficient, access to tax planning, and even a CPA to do your taxes. We have all that here. Consider the source. I would be very concerned if I was just going into a place where I was just going to throw it to one guy to do stocks and bonds, and he's telling me that he can guarantee me income if all of it's there. It might sound a little self-serving off the top to me, but again, I haven't seen the plan. It might be a good plan. Come in and we could compare if you want. At least go around, kick some tires with 3 or 4 other planners before you make the final decision.
Linda, we appreciate you listening to us in Vail and having the confidence and trust in us to send that question in. Again, 520-780-9059 is our number. If you would like to have a conversation with Jeff, it's just a casual conversation. Again, it's 520-780-9059. Okay, Jeff, let's stay south of town here. Let's head out west on Sahuarita Road, and we're going to end up in Sahuarita where John's listening to us. And John says, I'm a 51-year-old married man and pay about $200 a month for a $1.5 million life insurance policy offered by a private professional group. I also have $500,000 in term life insurance from my employer. I'm 5 years away from financial independence. At what stage should I reduce or stop paying for my term life insurance? Many thanks.
Well, I think the term life insurance is going to end up going up every time it renews for another term. If your death would cause someone serious financial harm or to have to live at a deficit in income, a significant deficit in income, then keep it until that deficit goes away. And the older you are, the less years somebody would have to live. Like if you died today, a spouse or anyone you care about that you're supporting would lose your Social Security or lose some assets, maybe pension or other things. So if you want to have that person live with the same lifestyle, then you might want to buffer that by keeping that term policy. I don't know how much it is. I don't remember you saying, but it might be worth keeping until you're 70 or maybe even 80 if you bought a 30-year term when you were 50 years old, and the price can stay the same. But I will guarantee you when you're 70 or 80 and you want to renew that term, it's either not possible to renew it or it's going to be super expensive where you're not going to be able to afford it. So term is cheap. And it does its job if you die early, but almost all term policies don't pay death benefits. Very few do. I mean, they're meant to run out before you die, but they're also meant to be there just in case. And it's always better to have it and not need it than need it and not have it. So that would be my answer.
John, thank you so much for listening to us in Sahuarita. And of course, you can always call Jeff at 520-780-9059. We'd be more than happy to have that conversation with you, no cost and no obligation. If you got a question you'd like us to answer on the air, you can get it to us by calling it into Shelley if you want, 520-780-9059, or you can go to the website, which is premret.com, premret.com. Use the contact page, and we'll be happy to answer it for you on the air. Again, if you'd like to have a casual conversation with Jeff, no cost, no obligation. Again, that number, 520-780-9059. Jeff, I know here at Premier Retirement, you do a lot of work with high net worth individuals in our area, and long-term care strategies for family with large estates is one of the things that you do help people with. Long-term care is a major risk for all retirees, but I think especially for families with large estates. What makes it such a threat to wealth?
I think long-term care is, no matter what asset class you're in, or whether you're a large estate or a small estate, long-term care can break you. Probably not a big estate, probably can't break you, but it can still whittle away at your funds. Some of the super low income people can get on Medicaid and have government pay for your benefits. Some of the middle class people have paid for years and years for long-term care policies, and the insurance keeps going up, and pretty soon they have to drop it and end up not able to use insurance and have to pay assets out of their own estate or mortgage their house or do a reverse mortgage or something so that they can pay for long-term care in the end. Long-term care is typically the second biggest expense, at least for the majority of our clients, taxes being number one. I think taxes and long-term care being the top two expenses definitely need to be spoken for. In some cases, people have a big house. I have several clients that just came in this week. In fact, we're starting to get near the year end and doing our annual reviews. And I have several clients that don't have kids or have kids that are so well off they don't need to worry about leaving them a legacy. And, their house is going to be the long-term care plan. In fact, somebody say, yeah, but I don't want to get sick, find out I've got Alzheimer's, have to go long-term care, and then I can't do a reverse mortgage or get equity out of my house, or I might not want to downsize because my spouse wants to keep living here, or maybe I want to live here. You can do a reverse mortgage where you actually get a credit line and you basically have it. You don't even have to use that credit line, but the equity in your house can be available to you at a drop of a hat at a moment's notice, like just writing a check on your own bank account, and your house equity, your home equity can be your bank account. As long as you're over 62 years old, and Jordan, my son, is in the Mesa office. He's got a background in mortgage and real estate, and so that's what he brings to the table, and he helps people unlock the equity in their home for long-term care so they can use all their money in retirement as footloose and fancy-free as they want, to the degree that it's responsible, obviously. But some people are like, how do I cover long-term care? Well, your house might be your bank, and you can basically set up that long-term care plan without forking out money on an insurance plan that you may just lose that money for because you never use it, or because it becomes so expensive you can't cash flow it anymore when you're 80 or 90. I've seen that happen far too often with too many plans. The other thing for high net worth individuals, because they typically have a tax problem as well. You mentioned the high net worth person of having long-term care. I don't really think the long-term care hurts them as much as all the taxes they pay. But what if you could kill two birds with one stone and have a tax plan that also cover your long-term care? And that's why I love LIRPs. There's some guys on the radio that go, oh, LIRPs are stupid. Well, if you compare them to a mutual fund and look at the long-term history of how much they grow, if you just start to finish and never touch them, yeah, a mutual fund will probably beat it. But if you look at how much cash flow you can get out, how much taxes you can save on that tax flow, you might find out that it beats a very good mutual fund account or even a Roth IRA that's invested aggressively. Has less volatility, has a death benefit as part of the cost of doing a LIRP, but that death benefit doesn't have to be paid when you die. You can actually use most of it up while you live by spending it tax-free. And when you die, that death benefit basically just pays off everything you spent during your life rather than wait to make somebody rich by dying. You can also save that death benefit or a portion of that death benefit to after you've used some cash flow that never shows up on a 1099 that you get to spend in your retirement, and then still have maybe $500,000 left in that account to use for long-term care should you get terminally ill. And you can stay at your own house. All you have to do to trigger it is just not be healthy enough. You have to be unhealthy enough to get the benefit, but you don't have to go to a nursing home. You don't have to go to an approved assisted living facility. You don't have to have so many visits with a doctor or rehab or go through all the hoops that insurance companies make you do before they pay claims. You can basically say, hey, look, I can't do 2 activities of daily living. I want my money, or I want my money to be paid out at a much more rapid rate, and I can use it up before I die. Just give an example, this guy that had a $3 million estate earlier, and he doesn't think the stocks and bonds are exciting enough, wants to do private equity. My thought was, let's not even look at private equity. I'll show you something that's kind of exciting, in my opinion. What if you put a third of that in LIRPs, one for you, one for your wife? And let's say you put $500,000 in, you got 1.2 to 1.5 million in potential death benefit, which is tax-free cash flow over the next 20 or 30 years. And let's say you used $1 million of it each over the next 20 years, and then you had to go to a nursing home. Well, maybe the remaining 500,000 would be available for long-term care. Oh, and by the way, remember the other 2 million you have? That could be growing in the market. That could be producing income in an annuity. It could be saving it aside for a legacy for your heirs. You could be gifting it to them while you live, whatever. The bottom line is all the income. By the way, if you took $1 million in income out of that LERP over the next couple of decades, that income never shows up on a 1099. It doesn't affect your IRMA for Medicare premiums. It doesn't affect your tax brackets. It doesn't take away from your standard deduction, doesn't take away from the deductions you might be able to get on direct contributions to charities and other things. So bottom line is it has so many additional benefits other than just the fact that it is principal protected and tax-free. The steady growth on it will outperform most other safe investments. And although it's not guaranteed, it's got a pretty good history of performing. You can back test it and see what history has done with these things. And I believe in them a lot more than doing a pay-as-you-go long-term care policy or just setting aside cash that you don't get to spend and don't get to use that you have to liquidate something later in order to pay for it. So again, a couple of different options there. Reverse mortgage, you can get a credit line against your house and pay for it, and that's tax-free. If you're healthy and younger, you might want to consider a life insurance version of a tax-free bank account that would cover long-term care and give you tax-free income as you need it throughout retirement.
Jeff, I'm sure based on our conversation here that our listeners may have some questions. If that is you're concerned about long-term care, whether or not you're a high net worth individual or not, you want some clarity on that, give us a call here at Premier Retirement at 520-780-9059. Talk to Jeff about this, no cost, no obligation. We'll find a solution for you. 520-780-9059. You can also check us out online at primret.com. Well, Jeff, we just get started and we run out of time. So for Jeff Ogun, I'm Jeff Shade. Thank you so much for listening to us. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.